Okay, let's get started. Now we'll start with the first question here. And the question that we are looking to do is the Darjeeling Co. Yeah, Karima, can you see my screen?
Yes.
Okay. So the topic that we are looking to do is called as Darjeeling Co. What about this particular topic? Let's get a strong understanding about this. So when we talk about Darjeeling Co., first we look into some analytical procedures. What about the analytical procedures? What are analytical procedures? First of all, that whenever we talk about analytical procedures, it is about comparing. What is analytical procedures? It is comparing. What do you compare? You compare the financial information, right? From year to year to year to year, this year to last year, this company to another company. So analytical procedures is all about evaluating. It's all about comparisons. That is about analytical procedures. What do you do here? We evaluate the financial information by identifying relationship, trends, and unusual fluctuations by looking into relationship trends and unusual fluctuations. Okay, you look into relationships, you look into trend, you look into unusual fluctuations. So that is called as analytical procedures. What do we do in analytical procedures? We evaluate the financial information by spotting relationship trends and unusual fluctuation, right? We do a lot of comparisons. Whenever we talk about analytical procedures, there's a lot of comparisons involved. Okay, so that is the first topic here. What we'll also do is get a good understanding from a point of view of what do we really understand with analytical procedures here. So let's get a good understanding about that in the sense that what is the purpose of that? Analytical procedures, it helps the auditors to identify risk, obtain audit evidence, and review the overall financial statements. So what are analytical procedures help in? It helps the auditors to identify the risk, obtain the audit evidence, and review the overall financial statements. So that is the biggest benefit of analytical procedures. If you compare this year and last year performance, okay, if you compare this year and last year performance, okay, what you do is you compare this year versus last year. What do you do is you compare this year versus last year performance. So that comes under analytical procedures. And what is the biggest benefit of analytical procedures? It will help the auditor to identify the risk and obtain the audit evidence. Also to review the financial statements. Okay. What do analytical procedures mean? Analytical procedures is about evaluating the financial information by identifying relationship, trends, and unusual fluctuations. So that is about analytical procedures. Okay. Next is purpose helps auditors to identify risk, obtain evidence, and review the overall financial statements. Okay. It helps the auditors to identify risk, obtain the audit evidence, and review the overall financial statements. What is the reference? ISA. ISA 315 is the reference. And analytical procedures is used in all the stages. Okay. So what do you mean by analytical procedures? Analytical procedures is all about analytical procedures. If we think about analytical procedures is all about us understanding relationships. How do we understand relationship? We'll do a lot of comparisons in analytical procedures. What do? We do a lot of comparisons. Okay, last year to this year versus last year to another company's this year information. Either we compare a lot of companies, either we compare a lot of previous year's data. Okay, 5 companies data we will compare, or the one company's previous year data we'll compare. That is called analytical procedures. What is the biggest benefit of analytical procedures? It will help the auditor to identify the risk. What is the biggest benefit is that it will help the auditor to identify the risk. What is the biggest benefit is that it will help the auditor to identify the risk. That is the biggest benefit. Okay, that it will help the auditor to identify the risk. Next, ISA reference. Analytical procedures, it is governed by ISA 315 and ISA 520. Okay, these are the two ISAs that will help us in understanding analytical procedures. Yeah, so let's write it down, guys. Here, yeah, Mamta Sharan. Let's write down what is analytical procedure. Analytical procedure is comparison, right? It is comparison of information in order to identify the relationship trends and unusual fluctuations. Okay, this is the biggest benefit of analytical procedures. You will do a lot of comparison of information. What you will do? A lot of comparison of information. What is an ISA reference here? ISA 315. What is your ISA reference? ISA 315 and ISA 520. Okay, ISA 315 and ISA 520 is your references. ISA 315 and ISA 520. Okay, what is your reference? ISA 315 and ISA 520. These are your references. What stages you use? Planning stage. You use the analytical procedure during substantive stage also, and you use it during the review stage. So first you write off that what is an analytical procedure in simple words. It is basically comparing information in order to identify relationship trends and unusual fluctuations. If you look into all your information, you will get to know a lot of trends. You will understand a lot of relationships. You will understand a lot of fluctuations. What is the purpose? It helps the auditor to identify risk, obtain audit evidence, and review the overall financial statements. What is the reference over here? ISA 315. Here, it's governed by ISA 315 and ISA 520. What is ISA reference? It is governed by ISA 315 and ISA 520. What are the stages that are used? It is used for planning stage, substantive testing stage, and final review stage. It is used in three stages. Right? Analytical procedure is used in three stages. It is used in planning stage of audit, substantive testing stage of audit, and final review stage of audit. It is used in all the stages. Okay, it is used in all the stages. So that is about analytical procedures. Okay, that is the first thing when we talk about is analytical procedures. Next thing that we look into when we talk about analytical procedures is which stages analytical procedures is used in. It is used in planning stage. Why? It helps us to find out the area of audit risk. Okay, where it is used in planning stage. It is used in planning stage. It helps us to find the area of audit risk. Second, it is used in substantive testing stage. Here, you can obtain sufficient appropriate audit evidence through analytical review. In substantive stage, how it is used? It helps us to obtain audit evidence. In substantive stage, it is helpful in using audit evidence. In final stage, they are useful for us to assess whether the financial statements are consistent with the auditor's understanding of the business or not. It helps us to determine consistency. Right? It helps us to determine consistency. So see, analytical procedures, it is useful in finding consistency. Right? It is useful in us obtaining or finding consistency. So analytical procedures are used in planning stage, substantive test, and review stage. It is useful in all the three stages, first of all. It is useful in all the three stages, first of all. Okay, first of all, it is useful in all the three stages. First of all, it is useful in all the three stages. Second, in each stage, how it is used. In planning stage, it is used in finding the main areas of risk. Okay, in substantive test, testing stage, it is used mainly to find the evidence. In final review stage testing, it is mainly used to ensure consistency. Right, in final stage, it is used to ensure consistency. In substantive testing stage, it is used to obtain sufficient appropriate audit evidence. In planning stage, it helps us to understand the areas of audit risk. Okay, so it is very helpful in planning stage, it is very helpful in substantive testing stage, and it is very helpful in the final review stage also. What is helpful? Analytical procedures. What is analytical procedures? Comparison. Why will you do comparison? To get a understanding of the relationship, trends, and unusual fluctuations. Okay. Why would you do comparison? It helps in identifying relationship trends and unusual fluctuations. What is the purpose? It helps the auditors to identify the risk and obtain the audit evidence. Right? It helps the auditor to identify the risk and obtain audit evidence. What is the reference over here? ISA 315 and ISA 520. These are the two references. Which stage it is used in? It is used in planning stage, substantive testing stage, and final review stage. In all the stages, it is useful. Okay, so what are analytical procedures? They include comparing financial and non-financial information. Right? They help in finding trends, they help in finding relationships, they help in finding fluctuations, they help in finding any unusual balances, and they also help the auditor to determine whether the financial statement appear reasonable or not. So first of all, we understood what is analytical procedures. Next, we understood what is it useful in. We'll get to know the trend. You will get to you will get to know relationships. You will get to know any unusual fluctuations. You will get to know any unusual balances. Right? And which stage it is used? It's used in all the stages. In planning stage also it is used. It is used in substantive testing stage also. It is used in final review stage also. It is used in all the stages. Okay, so first we understood what is analytical procedures, and then we understood the various stages it is used in, and then we understood the definition as well. Okay, then we use the definition as well. Right. So firstly we used first we understood what is analytical procedures. We understood all the stages in which what are the reasons why analytical procedures are used, and then we looked into the stages as well. Right, all the stages in which analytical procedures are used. Okay, then we looked into all the stages in which analytical procedures are used. Okay, so what are analytical procedures? What are the various uses and what are the stages in it in which it is used? So it is used in planning stage. It is mandatory using planning stage. It will help to find out the high risk areas. In planning stage, if we use analytical procedures, it will help us to find high risk areas. Second, it will help us to understand the client's business also. Second, it will help us to understand the client's business also. Second, it will help us to understand the client's business. Okay. Next, it will help us in identifying any unusual trends. It will help us in identifying any unusual trends. Next, it will assess the risk of material misstatements. It will assess the risk of material misstatements. It will help us to assess the risk of material misstatement. Okay, this is the benefit of using analytical procedures in the planning stage of the audit. It will help us to understand the client's business. It will help us to identify any unusual trends. It will as well help us to highlight any high risk areas. It will also help us to assess the risk of material misstatement. So these are the benefits of doing the analytical procedures in the planning stage. Next, we'll look into analytical procedure in the substantive test. In the substantive stage, it is mainly used in gathering evidence. In the substantive stage, audit evidence it is mainly used in gathering evidence. Okay, it is mainly used in gathering evidence. In the substantive stage, it is mainly used to gather audit evidence. That is the main reason why it is used in the substantive stage. That is mean during the testing stage, why do we use it? To gather evidence. Okay, why do we use it? To gather evidence. In the planning stage, why do we use it? To understand the client's business, to identify any unusual trends, to highlight any high risk areas, and to assess the risk of material misstatement. So in the planning stage, it is used for these reasons. That is to understand the client's business, identify any unusual trends, highlight the high risk areas, and assess the risk of material misstatement. So in the planning stage, it is used in these areas. In the substantive stage, it is used in these areas. What are the substantive stages? Analytical procedures can be used as substantive procedures to gather audit evidence, and substantive procedures mainly in this stage, it is used to gather the audit evidence. Substantive procedures include first you will do test of detail. In test of detail, what you will do, you will verify individual transaction. And in substantive test procedures, what you will do, you will use the relationship and expectation to test account balances. This is the next thing. Okay, so taking it from the start, first, what did we understand? What is analytical procedures? I hope this is clear. That is with the comparison, right? We look into numbers in this year and last year. We'll use of company, this company number, competitor numbers. You look into comparison. That is called analytical procedures. What does it help in? In finding the trends, relationship, and unusual fluctuations. Next, what are the stages in which analytical procedures are used? It is used in planning stage, substantive testing stage, final review stage. Every stage it is used. Next, in planning stage, what do we use? In planning stage, we use it. Now, what is about in using it in the planning stage? It understands the client business. It identifies the unusual trends. It highlights your high risk areas and it assesses the risk of material misstatement. Next, what it does, it assesses the risk of material misstatement. Next, what it do, it help you to assess the risk of material misstatement. This is in the using analytical procedures in the planning stage. Now coming to using analytical procedures in the substantive testing stage. In the substantive testing stage, what do we do? We utilize the analytical procedures in the substantive testing stage. What do we do here? Firstly, we gather audit evidence. What do we do? We gather audit evidence. Okay, first, what do we do? In this, we gather audit evidence. In which stage? Substantive testing stage. How do we use analytical procedures? We use it to gather audit evidence. Most important thing. Next, in the final stage, why do we use analytical procedures? It helps us to see whether the financial statement makes sense, first of all. Second, it helps us to see if the results are consistent. Third, it helps us to make sense about any unexpected changes that have been properly explained. It helps us to see if there's the unexpected changes that have been properly explained. Okay, so first of all, it helps us to see if it's making sense. Financial statements are making sense overall, first of all. Second, it helps us to see if the results are consistent. Third, it helps us to know about any unexpected changes that have been properly explained. Right? So this is why analytical procedures are used in the final stage. It helps us to make sense overall. It helps us to see if the results are consistent. It helps us to get to know of any unexpected changes. So this is why they are used in the final stage, right? To make sense overall, to see if the results are consistent with the business knowledge. It helps us to make sense of any unexpected changes that have been properly explained. So this is the final stage. Okay, this is about the final stage. Okay, so we finished the first part of the question, guys. What did we do first? We understood what is analytical procedures, the meaning, the reason why we need to use analytical procedures. Then we looked into the various stages in which analytical procedures are used. It is why it's used in the planning stage, how it is used in substantive stage, how it is used in the final review stage. Then we understood the planning stage. In planning stage, what do we do? It helps us to understand the client business, help us to see trends, help us to find risk areas, help us to find material misstatement. Then in substantive testing stage, that is the main testing stage. Here it is used to gather the audit evidence. In final stage, how it is used? In final stage, it is used to make sense. It is used to make sure the results are consistent with the business knowledge. It helps us to any unexpected changes that may have properly been explained. It has well to look into those changes as well. So three things we have understood: what is analytical procedures, how it is used, what are the stages in which it is used, and each stage we have looked into good detail. Okay, so that is pretty much the first part of the question. Next part, we have some ratios. So you have to just calculate some simple ratios here. So what is the formula for each? First is gross profit ratio. How do you calculate this? Gross profit by sales. How do you calculate the gross profit ratio? Gross profit by sales. So see, last year 36, this year 37. So gross profit is going up. Next, we have inventory holding period. You do inventory by cost of goods sold into 365. So that 45 days, now it's become 54 days. That means our goods are selling slowly. Our goods are selling slowly. So you see this 45 days has come to 54 days. How do you find it? Inventory divided by COGS into 365. Inventory divided by COGS into 365. So you'll get your inventory holding period. Gross profit margin, how do you calculate? Gross profit by revenue into 365, into 100. Gross profit by revenue into 100, you will get gross profit margin. Inventory by COGS into 365, you will get inventory holding period. Okay, so we understood what is gross profit margin, we understood what is inventory holding period. Okay, next we look into inventory turnover. Okay, in case of inventory turnover, we are looking into this here. So it gives us how many times our inventory is sold over, right? How many times does it take for our inventory to be sold over? So what do? We take the COGS and we divided it by the inventory balance. We take the COGS divided by inventory balance. How do we find out inventory turnover? We take COGS divided by inventory balance. Take COGS divided by inventory balance. Next, receivables collection period. We take receivables by revenue into 365. Receivables by revenue into 365. Payables, payables by purchases into 365 or COGS into 365. Payables by COGS into 365. You'll get your payable days. Current ratio is current assets by current liability. Current ratio. Quick assets is current assets by current liability. And current assets, you will subtract the current asset by current liability. And in current asset, we remove the inventory. Current asset by current liability. And in current asset, we remove the inventory. That is quick ratio. Right? Current asset by current liability. And in current asset, we will remove the inventory. That is quick ratio. Okay. Current asset by current liability. And in current asset, we will remove the inventory. Current asset by current liability, and in current asset what we will do, we will remove the inventory. Current asset by current liability, and in current asset we will remove the inventory. That is your quick ratio. What is current ratio? Current ratio is current asset by current liability. What is payables payment period? Payables payment period is payables by purchases into 365. Receivables collection period, receivables by revenue into 365. Inventory turnover is inventory COGS divided by your inventory balance. Okay, so these are the formulas. Current ratio is easy. Current asset by current liability. Quick ratio is also easy. Current asset by current liability. In current asset, you have to just subtract inventory. That is your quick ratio. Current ratio is current asset by current liability. Inventory is your inventory turnover. They are asking, that is your COGS divided by inventory. Receivables collection period is revenue by receivables into 365. Sorry, receivables by revenue into 365. Receivable by revenue into 365. Payable collection period is payable by purchases into 365. Payable by purchases into 365. Current ratio is current asset by current liability. Quick ratio is current asset by current liability. In current asset, we will minus inventory. Okay, in current asset, we will minus inventory. That is quick ratio. Current ratio. Payables payment period is again our payables by purchases into 365. Receivables collection period is receivables by revenue into 365. Inventory turnover is nothing but COGS divided by your inventory. Yes, that's it. Inventory balance. That is your COGS divided by inventory balance. That is your inventory turnover. Receivables collection period is receivables by revenue into 365. Payables is your payables by purchases into 365. Current ratio is current assets by current liability. Quick ratio is your current asset by current liability. But in current asset, you will remove inventory. So these are all the ratios that we have calculated. Okay. These are again all the ratios that we have looked into. Okay, I'll add in the table. Now let's look into audit risk. Okay, we'll at least look to finish half of the audit risk question here. Okay, so firstly, they are telling in case of audit risk. Now, for this, we will need the question. Okay. The first here, when we look into this particular question of Darjeeling, the first question that they had asked us that we have already solved is explain why analytical procedures are used. Okay. First of all, analytical procedures, and second, used during the three stages of an audit. Right? Explain why analytical procedures are used during the three stages of an audit. Okay. So how analytical procedures are used during the three stages of an audit. Okay. Explain why analytical procedures are used during the three stages of an audit. Okay. So during the three stages of an audit, why is analytical procedures used? Okay. Why is analytical procedures used during the three stages of an audit? We need to first note that. Okay. That why analytical procedures are used and during the three stages of an audit. Okay. So that is the first thing. Second, calculate three ratios. Second, what we have to do is we have to calculate three ratios. Okay. So what we have to do is we have to calculate three ratios, right? Which would assist you in planning the audit, right? Find three ratios which would assist you in planning the audit. We have to calculate the three ratios. So we have done the ratios also. Now we are looking into, we have to find eight audit risk. That is the final part. Find out eight audit risk and the auditor's response also. Next, what you have to do is find the audit risk and audit response. So these are the three questions. The first question we have already solved. We looked into analytical procedures over here. As you can see, meaning of analytical procedures, what it helps to find out, what are the stages, each stage, how it helps. We found that out. Then we looked into the ratios here. Here we looked into all the ratios. They told three. We looked into at least here seven ratios, 7 to 8 ratios we have looked here. Now finally they are asking how to give us the audit risk and the audit response. Right. Next they are telling us give us the audit risk and the audit response. So now we are looking into the risk and response question. Okay, risk and response. So that simultaneously we'll be reading the question as well, line by line. So it was a give us a good understanding. Okay, so let's look into that question here when we're talking from the Darjeeling company perspective. So you are the audit supervisor of Earl and Co. So your audit company name is audit firm name is Earl and Co. What is the name of your audit firm? Earl and Co. And who are you? You are the supervisor, okay? And you are been placing the audit of Darjeeling Co. Now they have sent you to do the audit of Darjeeling Co. Okay, that is the case here. Now there are some notes have been shared, so let's look into that. First is during the year, Darjeeling Co. has spent 0.9, which is included in intangible asset on the development of new product lines. Some of it were during the early stages. So now this is the first risk. 0.9 million is the first risk because research cost should not be capitalized. Early stage cost, which is not meeting the criteria, that development cost also should not be capitalized. So let's find out what is the risk. So in the first stage, we have a risk here. So let's look into the risk. Okay, what is the risk? The risk is that first some research cost would have been capitalized. So what they have told, 0.9 million have been included in intangible assets. Okay, this is not a problem. You can include it. But the problem is they're saying that some of the costs related to early stages. Some of the costs related to early stages. So in early stage, what happens is the risk is some research cost and some unnecessary development cost would have been capitalized. So the point is some research cost and certain development cost would have been capitalized. That is the first thing. What is the reason? All research and development cost have been capitalized, whereas IAS 30 says you should not capitalize everything. You should only capitalize those development costs which meets the criteria. Which cost you should capitalize? You should only capitalize those development costs which meets the criteria. What they would have done over here, they are telling all research and development costs have been capitalized. What are they telling? They are telling all the research cost, they are telling all the development cost has been capitalized. What are they telling? All the research cost has been capitalized, all the development cost has been capitalized, and that is wrong. Why? Because you can only capitalize those development costs which have met the criteria. What you can do is you can only capitalize those development costs which have met the criteria. Okay, what you can do is you can meet only those development costs which have met the criteria. Okay, you can only capitalize those development costs which have met the criteria. You cannot capitalize all the development cost. Here they're telling all the development cost has been capitalized. Okay, so you cannot capitalize all the development cost. You can capitalize only those development costs which have met the criteria. Okay, so what will be the impact here? Intangible assets in your expenses will be intangible assets will be overstated, your expenses will be understated, and even your profit will be overstated. That is the impact. And what should the auditor do? Obtain a breakdown of the research and development cost, inspect the supporting document, and distinguish between what is research cost, what is development cost, and ensure it is in compliance with IAS 38. Okay, so firstly, what you should do? What is the risk over here? That all the research costs and development costs have been capitalized. That is the risk. What is the solution for this? What is the solution for this? That only relevant development costs should be capitalized. All costs should not be capitalized. Only development costs which meets the criteria should be capitalized. What will be the impact of this risk? Firstly, your intangible assets will be overstated. Your expenses will be understated, and because your expenses are understated, your profit will also be overstated. And what is an auditor's action over here? Obtain a breakdown of all the research and development cost, inspect the supporting documents, and distinguish between research and development. Okay, and also ensure compliance with IAS 38. And also what you should do is you should ensure compliance with IAS 38. What you should also do is you should ensure compliance with IAS 38. These are the things you have to do as an auditor. Okay. Additionally, as the company is looking to expand, during the year it purchased and installed a new manufacturing line. Okay. Incurred and in the purchase and installation of the asset have been included within property. These capitalized clause include the purchase price, installation cost, 5-year servicing and maintenance plan. So see, servicing and maintenance plan should not be capitalized. That should not have been added. So what is the risk over here? Why did you add the maintenance cost? Maintenance cost you should not add. Wrong. So here what happened is maintenance cost have been included in the cost of PPE. That is why this is a risk. What will happen as a result? Your PPE and profit will be overstated. Your prepayments will be understated. So what the auditor should do? Inspect the document. Inspect the purchase documents, verify the servicing cost, calculate the prepayment, and ensure that the treatment is done correctly as per IAS 16. So first of all, what you do, inspect all the purchase documents you inspect, verify how much is the servicing cost, recalculate the part that is prepayment, and then ensure correct treatment under IAS 16. That is the auditor's action. Next, in order to finance the development projects and the new manufacturing line, the company has borrowed 4 million from the bank, right? So they have borrowed 4 million loan. So this is a risk over here. What is the risk here? That the incorrect split. There will not be a correct split. Between current and non-current liability, there will not be a split. What is the problem here? The risk is that there will not be a correct split between current liability and non-current liability. There will not be a proper split. Between current liability and non-current liability, there will not at all be a proper split. Okay, there will not be a proper split between current and non-current liability. Okay, there will not be a proper split between current and non-current liability. So what you should do, the current and non-current liability are misstated. What is the risk that the current and non-current liability are misstated? What is the risk that the current and non-current liability is misstated and there is an inadequate disclosure? Current and non-current liability are misstated and there is an inadequate disclosure, right? So also what you have done is you have not disclosed. Okay. So the 8-year loan may be correctly split between current and non-current liability. The split might be incorrect. So what you should do is confirm the loan with the bank review loan agreement. Confirm the loan with the bank. Number one, confirm the loan with the bank. Has this person taken loan or not? Second, review the loan agreement. Second, what you should do, you should review the loan agreement. Okay. Second, what you should do, review the loan agreement and verify that the classification and the disclosure have been done correctly. This is what you should do as an auditor. Okay. Along with that, the finance cost of that loan. If you take a loan, you have to give interest also, right? So interest on the new loan may not have been recognized. They would have not correctly recognized the interest only. What will happen? Your interest will be understated, profit will be overstated, and liabilities may be understated. So what you should do, you yourself recalculate the interest. Recalculate the interest. Inspect the loan agreement. Take the loan agreement, inspect it correctly, and agree whatever interest you have paid to the bank statement and the ledger just to ensure that the correct loan has gone, just to ensure that the current finance cost has gone, just to ensure that the correct finance cost has been paid. First of all, recalculate the interest. Second, inspect the loan agreement, and in the loan agreement, what you have to do is whatever numbers are there, you look into that, compare the numbers to the interest payment as per the bank statement and the ledger. Okay, inspect the same as from the loan agreement. You inspect the interest payment to the bank statement and the ledger just to ensure the correct loan has the correct finance cost has been paid. Okay, so we have done with 4, totally 8 risks are there. We will done out of 4. So what we'll do quickly, first we'll go through everything just to make sure that you are getting a context of what we have studied today. First of all, you understood what is analytical procedure. What is analytical procedure? Comparison. Right? You compare this year and last year. You compare your and your competitor. You compare. Right? Why do you compare? What will happen if you compare? So if you take a year and years and years and years and years and every year data, if you take and you compare and compare, you compare and compare, you will know about the trends, you will know about relationships, and you will know about unexpected fluctuations. Right? About what is happening in the company, what is the trend of the company, what are some fluctuations in the numbers of the company, and what are the relationship between various aspects. Next, you use the analytical procedure in all the stages. You will use in planning stage, you will use in substantive stage, you will use in final review stage. In all the stages you will use. In planning stage, what you will do, you will understand the business and you will identify the areas of audit risk. In the substantive testing, what you will do, you will obtain sufficient appropriate audit evidence. You can use that via analytical procedures. In final review stage, what you do, you use analytical procedures just to ensure consistency. Okay, we looked into that in a little detail. Then we looked into the ratios, right? We looked into the ratios over here. The ratios gave us a very good understanding. Okay, next part we did is we looked into the ratios. We understood gross profit margin, gross profit by revenue, inventory holding period, inventory by COGS into 365, inventory turnover, that is your COGS divided by inventory balance. Inventory collection period is receivables by revenue into 365. Payables is again your payables by COGS into 365 or purchase by 365, whichever is given in the question. Current ratio, current asset by current liability. Quick ratio, current asset by current liability. But from current asset, we will remove inventory. Then we looked into audit risk. I've simplified it over here. First problem is research cost has been capitalized. You cannot capitalize research cost. So that is the problem over here. So what is the impact of this? Intangible assets are overstated, expenses are understated, profits are also overstated. So what are the actions that you should do as an auditor? Obtain a breakdown of the research and development cost, inspect the supporting documentation, and distinguish research cost and development cost, and ensure that everything is as per IS 38. Next, in PPE, we look into the servicing cost. There's a 5-year servicing and maintenance cost have been included within PPE. PPE and profits are overstated, prepayments are understated. Next, bank loan classification. There's an 8-year loan. There's a risk that you have not split correctly between current and non-current. That split is wrong. So what you should do, confirm with the bank, go through the loan agreement, verify the classification properly, and ensure that the split is done correctly, disclosure is done correctly. Same with the loan, you must have paid interest also. So what you should do, interest on the new bank loan may not have been recognized. So you should ensure that the interest has been correctly recognized. Next, your finance cost will be understated and your profit will be overstated. Right? So if this is happening, what is happening? Your finance cost is understated, profit is overstated. So what you do, recalculate the interest, inspect the loan agreement, okay, and agree the interest payment to bank statements and ledger, okay, and agree the interest payment to bank statements and ledger. So that is about the finance cost. Finance cost, bank classification, and PP. So these four risks we have done. Tomorrow we'll be able to close this question.